My name is Jordan Selleck. I am the co-founder and CEO of 51 Labs. This is a business development and marketing firm focused on the M&A community. We're the #1 content producer on LinkedIn in the lower middle market with over 1 million views. We'd like to do good videos and get, I guess, you LinkedIn famous, if that's a thing now. In fact, Bob and I, we shot a video. Our video got something like 10,000 views. You're my first vlog that we did to get this kicked off a couple years ago. Let me kind of jump into our agenda for today. First, we're going to do some panelist introductions for the private equity panelists. Then we're going to do the sponsor introductions with Ewan Relly from BDA and Duncan from Kirkland. And then Ewan's going to kind of go through some thoughts around global developments in M&A and private equity. And then there's going to be an open panel discussion. This is meant to be interactive, so if you are attending, please feel free to drop in any questions that you have along the way. We want this to be interactive and interesting. And a couple other housekeeping items. This is recorded. This is going to be turned into a full video. Going to be micro videos. There's going to be a podcast and a written summary available. A lot of people who we had emailed said they can't attend. They're in Asia. It's 12 hours ahead. It's a little late, but they wanted to see this, so we will be sending it. If you have any questions, feel free to contact me, Jordan Selleck, at jordan@5149labs.com. So I'm going to turn it over to the panelists. And if you are, let's start off with Andre. Duncan and Ewan, would you mind just hiding your video for a quick second, and we'll turn over to Andre for his introduction.
Thanks, Jordan. Andre Puong. I'm a partner at Cathay Capital Private Equity. We are an investment platform, a little bit under $4 billion US in AUM, created 15 years ago, and with offices in East Asia, in China, in Singapore, and also Europe and North America. I am based in New York, and we invest in minority and control deals from Series A all the way to buyout.
Awesome, thank you. Bob? All right.
Yeah, Bob Landis. I'm a partner at the Riverside company. We were founded in 1988 with a thesis of looking at little leaders at the lower end of the market. And although we started with one person in 1998, and now we're a company with assets under management of about $8.5 billion to $10 billion, depending on how you account for it. And we have we've bought over 699 companies. Currently, we have 112 companies in our portfolio with 9 funds around the world. We've never deviated from that strategy. We have always focused on the lower end of the middle market, and we will continue to do that. Various funds, a lending fund, non-control fund, software fund, 2 private equity funds control in the United States, 1 non-control, 1 in Europe, and 1 in Asia.
Awesome, thank you. And Joanne?
Hi, Joanne Yu, Managing Director at DPI. DPI is a leading Pan-African private equity firm. We invest in companies that benefit from the growth of the emerging middle class. We're headquartered out of London, but our investments are based all across the continent in more than 30 countries, and we're currently investing out of Fund 3. We also hold very strong ESG practices and also an impact strategy, but deliver commercial returns for our investors.
All right, and now to one of our 2 main sponsors, Duncan. Let's unhide your video, and if we could hide the other panelists.
Great. So I'm Duncan Mista. I'm a partner in Kirkland & Ellis's Boston office. Kirkland's kind of a global firm, 15 offices around the world, and a reach that goes much further than that. You know, we try and kind of follow our clients wherever they find value. So we have a reach across all the countries around the world, and look forward to a really fun and exciting discussion today.
And Duncan, can you talk a little bit about some of the cross-border activity that you do?
Sure. So again, we just, wherever our clients find value, we try and follow them there. So, not only do we have practices around the world, but we have clients, almost 500 private equity clients around the world that are geographically agnostic. So we try and follow the transactions wherever they are, as opposed to be tied to one, jurisdiction in the United States.
Thank you. Ewan?
I can't start my video because the host has stopped it, but maybe you don't need a video, that's fine.
We do, definitely. Let's get it going.
I'm Ewan Relly. Thanks a lot for organizing this, Jordan. Thanks to everyone else for joining. I'm very pleased to have worked over my career with most of the people on this session and with all of the firms on this session, with the exception of DPI, We're unsophisticated, so we haven't done anything in Africa yet, Joanne, but we know your firm very well by reputation, and I'm really glad to have the chance to meet you. We've tried to build a best-in-class mid-market advisory firm connecting Asia with the rest of the world. I co-founded the firm 24 years ago, so I was in my late 20s when I started the firm, and I'm now in my mid-50s today, in the strange position of being an employer and co-worker to quite a few young men and women who were not born yet when I invented this company. So that's a bit strange. But we have watched the development of the private equity industry, really the proliferation of private equity in Asia. And we are excited about the good things that private equity is doing for the markets in which we operate.
Awesome, thank you. All right, let's move over to global developments in M&A and private equity with an update from you. And as we're going through these slides to the guests, please feel free to drop some more questions in this and to the panelists. Let's make this an active discussion. We can either do it through these slides or at the end, however you'd like to. But Ewan, over to you.
The rather well-known Chinese dictum, kind of an insult or a curse that Chinese people use sometimes is, may you live in interesting times. Well, we're certainly living in interesting times at the moment. COVID has meant that global buyout activity has dropped precipitously, something like 60%, according to the analysis that we've done. But at the same time, there's a record amount of dry powder globally. So there's a huge number of private equity firms thriving, continuing to raise big sums of money and trying to put that money to work, but in an environment where it's hard to do diligence, it's hard to close transactions. Obviously, the banks always say they're open and lending, but it's harder to raise debt capital to support LBO transactions. Valuations have stayed fairly high. I was surprised by our analysis that the average enterprise value to EBITDA multiple on global transactions last year was 11 times. And I think we say in the US, most transactions trade at higher than that. So, this is a very robust sector with lots of money, where lots of money has been put to work. And obviously the intention is the private equity firms have to keep buying. It's a hard time to sell too, but they have to keep buying and selling today in a market which is very challenging. Maybe we'll move to the next slide, Jordan. U.S. private equity, $1 trillion. That's a number so big. Even though I'm an investment banker, I don't really know what $1 trillion is, but that's a lot of dry powder. Some of it represented on this call today. And I want to just mention something we've seen specifically. KKR has been quite public and vocal about this. They said KKR missed some opportunities in the last sharp downturn in 2009, and they were excessively cautious over that period. But the transactions that come from that vintage have performed very well. And so KKR has expressly determined through this year that they will continue to deploy capital aggressively, including notably in Reliance Jio in India, where just about everybody's piled in to the tune of $20 billion combined private equity investment over the last couple of months. So, the U.S. private equity market is still the most sophisticated in the world. The players here in the U.S. are the most sophisticated in the world. It's the most competitive private equity market in the world, but returns have been pretty good. Through the first half of this year, we saw naturally those private equity firms turned their attention to their existing portfolios, tried to fix those portfolio companies to the extent they could, reducing costs in many cases, but also finding different ways to preserve cash and to take full advantage of any debt facilities that they had. But again, this is now arguably a pretty favorable buying environment. What we normally see in markets, downturn markets like this, is the biggest guys gain market share. They can still get deals done where some of the more marginal and smaller players find it harder. So we're seeing strong activity from the biggest players in the market. but obviously numbers are going to be down overall pretty sharply this year, both deal count and deal value. Maybe Bob, I'll just ask you to jump in here. Bob, your firm Riverside is a U.S. domiciled firm, a firm that has historically operated in lots of international markets, but obviously your home base is clearly the U.S. Maybe I'll ask you how Riverside is performing today, and what your priorities are in this market.
You know, it's interesting, and as you were talking, I was making notes on that one page on the U.S. private equity market, and my first response was where you're talking about focusing on portfolio company operations. We shut down or stopped going into the office on the 13th of March. 2 days after that, we created virus response team to address that. And we started looking at every one of our portfolios, the 82 that we control, and then all the ones that we have either loans in, what can we affect on those? First thing we did was say, okay, let's do 2 different budgets, 25% decline in revenue, 50% decline in revenue. Come back to us in a couple of weeks, tell us what's happening, what are you going to do if this happens, and what are you going to do if it's a 50% response? Some of them were 50%, some of them get affected, and some of them we were able to pivot incredibly quickly to, even though we were classified non-essential, we became essential. We have a couple textile companies, Marina and Elite make gymnastic equipment and compression equipment. We started making gas masks because of the supply was minimal. Did the same thing in Europe with Galvanina. We had a alcohol distribution company. We converted some of the lower priced products to making hand sanitizers. Moving on to the other one, the favorable environment for smaller bolt-ons. Since we shut down, and I don't want to say shut down, since we departed from our offices and working in our own beautiful environments at home, we've bought 18 companies. And as you pointed out, a significant number of those have been add-ons. So the last week, we sold a company and bought a company. So there is some activity on the exit side. And then the alternative structures.
Hey, Bob, back to that point on buying companies.
Yeah.
You know, you have, 112 companies and are one of the most active players. Have you bought companies, either platform or add-ons, that have been with no on-site diligence or very minimal on-site diligence? And then after that, Duncan, I'd love to hear your perspective from a legal point of view. And Andre and Joanne, same question to you afterwards.
Best way to answer that, is it better to buy a poor company with good management or a good company with poor management? I'll take the poor company with good management because you can work on that. What we have found, and again, the majority of the companies we bought or add-ons, although there have been some platforms, and I'll address that quickly, but what we have found is that most of the companies that were platforms, we have already met the management. One of my colleagues, Matt Daly, who is, he does research on specific segments like TIC and food services or food products, food safety. He drug our investment professionals out 4 or 5 months before this happened around Christmas time, said, I've got all these companies I want you to see. And the investment professionals are very busy. They said, well, we've got all these other things. On the first visit, just tell us, no, you come with us. Of those 5 companies, we bought 1 and 2 or 3 we're still interested in. Many of the companies that we have met, Lincoln and some of the other investments where they have the one-on-ones, we've attended those. We got a really good feel for that. Jefferies has done the same thing with their healthcare conference, Raymond James. By attending those, we got to meet the management ahead of time, so it made it a lot easier. You're right, the on-site inspections, it's still a tough one, and we haven't done that many platforms. But in the one company, the Riverside Acceleration Capital, where they provide 2 to 5 million of loans for startup ventures, as long as they have at least 3 million of ARR. I mean, if you go do an on-site investment for a software company that's 3 million of ARR already, you're going to see a bunch of software engineers, maybe in their sweatsuits, creating code. And all you have to do is look at their books, you look at their sales, their revenue. There's not a lot of tires to kick. Manufacturing, it's a lot different. So I won't say we struggle, but we're trying to get around it. We have thought about one add-on, maybe even chartering a plane because they're up in Canada and we take our management and everybody puts on their mask and sit around the table. We're going to work on that. It's harder, it's a lot slower, but it can be done.
Yeah, I know there was a deal done, a Chicago-based investment advisor, a Swiss company, a strategic, bought I think it was a Chicago-based consumer products company, and there was no diligence, but it was a strategic, and they've been following that asset for years. So I didn't know if there were new deals in the pipeline that advisors had shown you, Bob, Joanne, or Andre, that, you're like, yes, we can underwrite this, and we're just going to adjust it in a different way because we can't do as much diligence. But Andre, Joanne, love to hear your perspective, and then Duncan, what you've seen from the legal side.
Yeah, I think very similar to Bob. We have closed acquisitions, to what you just said, Jordan. We have closed acquisition, and I will qualify them as from two different perspectives. One, geographically, the platform acquisitions that we have closed in the past 2 or 3 months were primarily outside of the U.S. And that speaks to some extent to the progress of recovery, and I would say level of still uncertainty that there is in the North American PE market in terms of underwriting any financial figures, any financial projections at this point in time. And in Europe, second point I would like to make on this closed acquisition is that those are assets indeed that our teams in Paris in particular, or in Germany, have been following for a number of months, if not years, been in either preemptive situations or have known the assets very well and were really prepared and have met the management teams prior to the COVID lockdowns. Here in the US, we are in the process of completing one add-on without any management meetings and on-site due diligence, but it's a very small asset that tuck in the e-commerce space, and primarily to pivot a business into the digital world. And this tuck in itself is actually a fairly decentralized virtual business, if you will, with people in the Philippines and founders traveling all around the world. So even pre-COVID, we wouldn't have met the founder and the management team. And obviously, also because of the tuck in, we are relying on the current platform, the acquirers platform, the current platform management team to really run this business post acquisition. So to sum it up, still a little bit hard to invest in companies that you hear and meet for the first time virtually and underwrite it as far as we're concerned at Cathay.
Nice. Joanne?
Sure. So for DPI, nothing has changed from a deal perspective. In fact, we're busier than we've ever been before. But just to take a step back, the pandemic didn't come to Africa until much later. And so didn't come to the continent until the end of March, and it was really brought by people flying in from Europe. But thankfully, Africa actually shut down early, the same time as Europe. So every country banned international travel. Most countries had total lockdown and curfew and really just limited the number of people. So again, the virus didn't spread. So domestically, the population just, again, did not get infected. Africa also has the youngest population in the world. The average age is about 20. And so we know that this virus hits older, more vulnerable people. And Africa is just not as connected to the rest of the world in terms of flights. So overall, while COVID-19 is a global issue, Africa on a relative basis is doing much better. But
Joanne, can you talk a little bit about like the portfolio? And it'd be interesting to kind of hear how your portfolio companies might have compared to more global platforms or US focused platforms that Bob and Andre work with.
The difference, I think, is that we don't participate in auctions. We're really working on proprietary deals. And so nothing's changed from a deal perspective. We just closed a deal 6 weeks ago in the agribusiness space, no COVID impact. We just signed a deal last week within the pharmaceutical space, which is much needed for Africa, and we're intending to close. We also have an investment in the fintech space. Everyone's using their phones more, so that business has performed well. So overall, what we're seeing in our current fund is that our companies are in defensive industries. essential sectors. From a deal structuring perspective, we made sure to structure in downside protection, providing a minimum level of return that's actually enforceable, structuring in earnout provisions, management incentives, or even tranching our investment. In terms of our portfolio work, we developed a proprietary Africa CEO checklist that was really developed as an organized way of working with our companies. We decided to make this open source and publicly available. We didn't feel like this was a time during a pandemic to be proprietary for information. So we shared it with our investors, shared it with other private equity firms, and just, again, with African CEOs. And so in terms of this work, the first thing that we made sure was that every company in our portfolio had a COVID task force, which was typically the ExCo. Then we did a lot of scenario planning with our companies to ensure that they had strong balance sheets. So again, modeled in full shutdown, partial shutdown, and lockdowns ranging from 6-month, 9-month to 1 year. We found that most of our companies had adequate cash and working capital. Then we looked at supply chain, which was less of an impact in Africa because you can't do just-in-time inventory like the US and Europe. So most African companies hold about 6 months of inventory because they have to stock up. And then I think lastly, what we found was that more than 2/3 of our portfolio was deemed as operating in essential industries and businesses. So again, weren't impacted by shutdown. So overall, what we're seeing is a good portion of our portfolio is up year over year. And even as we're getting June numbers in, are up month to month.
That's awesome. Duncan, love to hear your thoughts.
Sure. So Joanne actually just said something very interesting that I'm actually seeing quite a bit. So during the lockdown, closed a handful of deals from my basement, one in Switzerland, one in Germany, another in France, one in India. And many of these were add-ons for the same platform. And as the kind of lockdown matured, we started to see the use of earnouts a lot more. And I think that that's, risk shifting on the kind of financial diligence a little bit to the sellers, which were, maybe were prevalent for a while, but had started to kind of, be offensive in some of the more hot auctions. But we're starting to see a little bit more of that. I don't know if that's a global trend or if it's just in some of the industries that are still trading during the lockdown. Also saw a lot of pressure kind of on the legal diligence side on making sure that the customer and supplier relationships were, that we took that diligence kind of one step further, meaning it's not enough to diligence kind of the legal contracts with those customers and suppliers, but it's also important to kind of diligence the health of those customers and suppliers, because if the company that you're looking to purchase is healthy, but its commercial relationships aren't, puts a lot of pressure on the kind of the case that your client's making to acquire that company. So hopefully, Joanne did mention that the kind of maturity of the progression of recovery does have an impact, and we're seeing our clients kind of go overseas to try and find value because there's a lot of uncertainty in that in the United States. But hopefully we're turning a corner here as well, and deal activity is beginning to pick up.
So I thought it'd be interesting to kind of talk about when you look at the past 6 months and deploying new capital, what are the opportunities you now see that we might not have thought about 6 months ago? And I'd be curious to hear kind of what you see, maybe from an industry perspective or maybe geographically focused. Andre, I'd love to start with you.
So we have at Cathay a very wide spectrum of investment strategy. I mean, not strategy, but just investment stages that we can deploy capital in, going from Series A, which is more tech focused for us, all the way to buyout. So I think what has permeated through the past 3 months is that we are seeing a lot more trend towards digitalization of some of the more established businesses in our portfolio, but also we see bankers that, or at least those who are still showing us any assets and even investment opportunities, more focused on making sure that they emphasize how well the companies are doing, the clients are doing on Amazon and our digital channels, and how they are performing on social media, including TikTok, etc. So we are seeing, so we are definitely following that trend, putting more emphasis on how to see new opportunities through the lens of what does that mean in terms of when you have people working more remotely. What does it mean in terms of, we are very active in the office furniture space, and, definitely this vertical is getting upended by, in the US at least, in terms of, how people are going back to work, or the lack thereof of returning back to the offices. We are, generally speaking, leveraging also our knowledge, experience, networks in the tech world to have a view on how certain industries are going to evolve. And we know that in the consumer space, it will be more, obviously more e-commerce. But we also know that in the food and beverage industry will be more wellness and particular attention to ESG, to and health conscious projects, conscientious consumption will be on the rise as well. We are continuing to be very active in the healthcare space. Two of our investment in Europe in the past 3 months have been in the healthcare space, CDMO and some data analytics in serving the healthcare industry, and we continue to believe that it's a very good vertical to deploy capital in. I think those are very obvious themes and verticals that we are focusing more efforts on. Again, we are generalists, like the co-panelists that we have today in the firms, and so that's give us a lot of flexibility in terms of refocusing, reshifting some of our efforts in terms of sector focus.
Awesome. And before we kind of go around, I think this your point about TikTok raises a really interesting point. I was reading, I think it was in Axios, that TikTok might even be banned in the US. And it's made me think about one of my good friends who has like 5 million followers on TikTok. A significant amount of his business is due to that. For me, it's the same thing with LinkedIn. And it kind of made me think about just highlighting the importance of diversifying. And it's so hard, like when you're in a crisis, you want to do what you're best at, you want to get really deep in it. But that was just another reminder about whether it's your services or products that need to diversify. It'd be interesting, just kind of, maybe I'll throw that one out there, we can come back to it. But I just thought it was a really interesting point about the need to diversify even when it's a crisis.
Well, I think particularly now, I would say we broad range of clients, and we see some of them are fleet of foot. I think, we live in these very volatile, edgy times. Good companies react fast, and good entrepreneurs, Bob talked about the importance of strong management. I think good entrepreneurs know how to react and make decisions on the fly. For the companies I see that perform well, it's not even about getting the decision right every time. Nobody's going to make the right step every time, but being able to act and react quickly is clearly pretty important today. We see that in the companies we work with globally.
Ewan, what have you seen in terms of the services? Because I've, 5-6 months ago, it sounded like there was a new service line for restructuring and 95% of advisors out there. And it's like, it's part of that defensive mechanism where they just had to figure out how to work through this. But I was curious to hear, like, where you are at now, where the business is at with BDA. BDA has been around for 24 years. You've been through cycles.
Yep.
How does this cycle and how the firm is reacting in terms of providing services globally, how have you adjusted?
Well, again, we're trying to be fleet of foot. I'm 52 years old, so I'm not going to change what I do tomorrow. And actually, we have a very good partnership with William Blair, which owns 10% of BDA. They've decided not to go into restructuring. And I'm surprised. They keep saying, why aren't you building a restructuring team? They've decided that they'll find ways of making money from M&A. Definitely one of the slides we had talks about pipes. We're seeing some interest from private equity firms in making investments into publicly traded companies that may need capital in a way they didn't previously. Absolutely, I agree with Duncan that people are looking at structuring in other ways. But for us, it's still about core M&A. And actually, this is when we earn our money as bankers in difficult times, in helping to get transactions done, in bridging what happens automatically when things turn down. Buyers become more cautious, and sellers tend to say, we're not going to sell at a massive discount. So you have to try and bridge that, and earn-out's an obvious way of doing it. We've been spending a lot of time, it seems rather nerdy and boring, but we've been spending a lot of time in trying to figure out how to present companies' financials appropriately. Typically, we work on the sell side more often. So we're trying to help business owners present their business this year in a market where maybe there was an interruption of business. So how do you normalize EBITDA? How do you say, you know, we had a great first quarter and then business fell off a cliff in March and April. How am I going to present my company going forward? Because I don't want to be paid only 3/4 of the price just because there was a short-term shutdown. And I think, again, this is about being, you know, there's a limit to how creative and aggressive you can be, but I think it's about being smart and reasonable, intellectually robust, but also creative in trying to structure things. And that's how we're spending time. Because the difference in my business, in the investment banking business, and I think it probably applies to private equity firms and maybe to lawyers too, you have to keep the close rate high. You know, there's no point in spending tons and tons of time on deals that don't close. None of us is going to make a living that way. So we have to find a way, even when markets are tougher, to get stuff done. And it requires, you know, being smart, being tenacious, being creative, and having the confidence and experience to navigate what are treacherous waters.
Well, let's take a pause and kind of shift over to some of the questions over here. Anonymous attendee, will the China +1 strategies of many companies mean that there will be a lot of operating assets for sale in China? And will those assets retain their value over the following 5 to 10 years? Who would like to take that?
Well, you've got to let me have a quick one on that. So China has been, our biggest office at BDA is Shanghai. We've got 20 professionals there. Cross-border, the relationship between China and the US is not terrific today. Both political parties, this isn't just a Trump administration thing, both political parties in the US are pretty down on China today. And to a considerable degree, we're seeing the same thing from European investors and so on. Actually, again, one of the first things I was taught as a banker is change creates opportunities. So we're seeing a lot of multinationals think about divesting their assets in China, and we need to figure out how to help them do that. What it means for us is that China M&A activity is becoming more domestic Chinese rather than cross-border. So the stuff that we're selling in China today, we can get deals done. It's mostly going to Chinese buyers. And that may be Chinese private equity firms or Chinese strategics, but that's fine. We're happy to get that done. I don't know, Andre's firm is famously China connected, well connected in China, and has done extremely well as a result of that. Andre, I don't know how you guys are dealing with the fact that cross-border is much harder now as it pertains to China.
It's great for us, I would say, because we are, although we have used the word cross-border to describe ourselves in the past, I think at the end of the day, we are a global platform with local teams. So in China, we are viewed as a local acquirer, local private equity firm. In the US, we view as local, but we're leveraging, and same in Europe, and we're leveraging a global platform. So I think we are, you know, CFIUS and tariffs and all these issues have been extremely big impediments to a lot of our competitors, especially strategic ones, in terms of when it comes to Chinese acquirers, strategic acquirers in particular, trying to acquire assets here in the US. So we have not seen the like of, you know, the big conglomerates, you know, I don't want to name anyone here, but, you know, in any process, you know, in recent, I would say, memories. So it has played in our favor, but it is true to your point that, you know, it's harder and harder to, and if you want to do the converse in terms of being a, let's say, even a strategic buying assets in China, it's become harder and harder. A lot of capital raised in China for the domestic market, competing with the more established global funds. And if you don't have it in, if you don't have, you know, as some of my colleagues say, if you don't issue a term sheet, you know, in 48 hours, you're out of the door. It's worse than Silicon Valley.
Very interesting. Bob, Riverside historically has been pretty global in the things you've looked at. I suspect you may be looking more at the US and Europe today than Asia. Is that the case?
The majority of our assets and people are in the United States as well as Europe, but our very first fund focused in Asia. It was Pan-Asia. We had an office in Korea. We had an office in Japan. We still have an office in Hong Kong that provides more advice and sourcing. You know, if we're trying to source out of China, our people in Hong Kong know everybody in China. By that, I mean, they know somebody who knows somebody who knows somebody who can do the due diligence, as well as Taiwan, as well as Korea. So They're not necessarily the investing side, but they are a service part of our business. Our more recent funds have focused, because we've had moderate success. I mean, we did some pretty good deals right off the bat in Japan, which is atypical because it usually takes you 10, 15 years to get to know people, but we always hire local. But the amount of deals and transactions that we did in Korea and we did in Japan, and we've never done a real platform. We've done greenfields, but they've been subsidiaries of a U.S. company, have panned out. But we're here, and it's a little bit more difficult. So we've now focused almost all of our business in New Zealand and Australia, and that's where our main office there is in Melbourne. So it's, I won't call it a retrenchment. I'll call it a view as to where is the best source of our assets to be deployed.
Makes sense.
Yeah, and Andre mentioned something that bears repeating with CFIUS and just kind of government intervention in the M&A process. How that's certainly not helping the U.S.-China M&A activity, but it also, the government intervention in M&A process is not helping Europe either. With the advent of GDPR, for instance, is putting a lot of pressure on companies in that regard. Privacy laws tightening in the U.S. for companies coming into the U.S. ITAR regulations for companies that trade in arms and munitions. So we do see appetite across the world, not just in the U.S. and with this administration, wanting to tighten the screws on the M&A process, to the extent possible.
I would maybe just add what's interesting with regards to your reaction to TikTok, Jordan, is that you are seeing further decoupling of China versus I would say the Western world when it comes to some infrastructure, where we're talking about e-commerce, social media, usually on the technology side, and that's getting exacerbated. And that exacerbation, it results, doesn't really impact the fact that a lot of companies, whether in business services, healthcare, or in running consumer, still, at some point in time wants to go to China, or Chinese companies will increasingly want actually to go to Europe. And they are still very active in Europe when it comes to M&A. I would believe, compared to the US especially. So you need investors, you need partners who understand how to do business still cross-border, how you understand distribution channels in China, how you understand, even if TikTok tomorrow becomes only a Chinese platform, well, it's already too big in China. You can't avoid it. And that's the reality. And if you don't understand it, forget about it. You probably, in the next 18 months, won't be able to do any business in the consumer space in China if you don't understand that platform. So
you think that this is just going through the same cycle of 10, 15, 20 years ago, okay, we're going to go multinational, go to China, set up the facility, IP is taken, but hey, guess what? We got to stay there anyways. It's a long play. Are we just seeing the same theme play out?
Yes, it's even longer play these days. I think 20 years ago, you could do business in a hotel lobby, luxury hotel lobby in China, and then find a lot of partners, distribution partners knocking on your door if you have a good product and a good brand in Western markets. Today, you have increasingly competitive local brands, competitors that are going to eat your lunch if you're not extremely aggressive, if you don't localize your business, from the get-go. I think it's less of a repeat than increasingly difficult environment for multinational and for wannabe multinational businesses that don't understand that they can't use the playbook of 20 years ago and say, you know what, I have a good brand, good product, China needs it, and I'm going to give it to them. There's a lot of hurdles to overcome before you can even sell one single item to the Chinese consumers these days.
I agree with that. I think the global markets are evolving fast, and I think there is clearly for some political reasons, notably there's some retrenchment at the moment as protectionism is nationalism and protectionism feel like the flavor of this month. But I'm not pessimistic at all about the longer term. We're seeing big private equity firms starting to deploy serious capital in India. There's a jockeying for attention. Should they turn their attention to India to some extent instead of China? But we live in a very connected world, and I don't expect that to reduce. We still have, as of today, I think there are 1 million foreign students studying in the US today. Those students are going to go back to the rest of the world, and they're going to want to communicate and do business together. And sooner or later start traveling. And so the notion that we're decoupling permanently doesn't make sense to me. That's not something I see. And I think, most ambitious young men and women want to be global in the future. So again, the smartest investors find ways to navigate the hurdles, but we are going to stop being a globalized world.
I have a question, like, what do you think about returns for investors? People who were going to China first and then went through this cycle over the past 5 and 10 years of outside investors, the largest funds doing that. Are they shifting their risk profile towards more emerging markets with less hurdles and just more opportunity and just higher returns? Bob, I'd love to hear kind of your perspective of what that looks like from Riverside looking at globally allocating as well as across funds. And Joanne, I'd love to hear your thoughts around kind of what this means across Africa and the evolution of it.
Since the growth in particular of the past 18 years, we have continued to expand globally as well as diversification into the United States. To go to Ewan's point about his last point on his slide about diversification, we have that Riverside Value Fund, which is now looking at slightly distressed companies that have fixable flaws, and they're looking, anywhere in the world that makes sense. As far as Asia goes, we've been making more of our money in Australia and New Zealand, but that office in Hong Kong is very, very important to us. It gives us a presence and a foot into the Chinese market. We've never done a platform there, but we have done lots of business. We still continue to source. I think because of COVID, people are going to start looking at different supply lines. They're going to look for greater diversification. They want somebody, they don't want to have to depend upon all of our drugs on one company, all of our PP&E, protective equipment on one country, but there still is going to be a rationale for diversification of supplies. And China is clearly one of the premier manufacturers. And it's not just China, Vietnam, Cambodia, Thailand, India. We're constantly looking, and we're expanding there as well. I think what most PE firms are also going to start looking at is, and this is not a patriotic statement, it's a simple logistics supply line by America. They need to have some foothold in the United States. They've outsourced everything. And the supply line time, if with one little, it's very thin. And it's always that change. As we started to go through that old Bain discussion that they came up with in May about what PE firms should do. First thing you look is your supply lines. And now that we're coming, I won't call it a recovery, but it's coming into the next phase of we've fixed our PE firms, or we've addressed that. What do we do for the future for retooling? We're looking at all the supply lines, and it's always a very, very fine line. How much do we spend for greater diversification of supply lines versus looking only at the bottom line? And if a pandemic happens or some other disaster or relationships with China again come worse, we have no supply line.
Yeah.
So I think we're starting to look at that, but I do not think that most rational businessmen would totally exclude China. I will say that when they get to the border, they leave their cell phones and their laptops at home for the rational.
Okay, well, now we need to address the elephant in the room, Hong Kong. Ewan, the advisor here. We'll let the investors kind of step aside. I'll let you do this. Hong Kong. So is it really going to be the center as it is and as important as it is, or are investors, are multinationals saying, I'm out of here, I'm going to Singapore, I'm going to another emerging market? What do you think in the next couple of years and maybe even mid to long term?
I think things evolve, and I think the role of Hong Kong will change. I think the mood in Hong Kong is very bleak today, frankly speaking. It feels like, they had civil unrest, they had pollution troubles, they've had political concerns with the mainland, and frankly speaking, it's bleak today. So both bankers and private equity firms are moving already. And we've seen this week the New York Times has moved some of its editorial to Seoul. We're seeing, our own bankers are less keen to bring up families and children in Hong Kong than they would have been, and Singapore will be a beneficiary of that. Having said that, there are unintended consequences and things that you don't realize at first. Hong Kong may benefit in some ways from being tied closer to China. We're seeing lots of Chinese companies who are less keen on potentially seeking IPOs or stock market listings in the West and are thinking of doing that in Hong Kong instead. And so, we can be sure that the Chinese authorities, however ham-fisted it seems sometimes, Chinese policy, they're not totally self-destructive either. And the Chinese authorities will do what's needed to make sure that Hong Kong preserves value and remains an attractive place to do business. But in the shorter term, I think it is kind of being combined with China. We're seeing quite a sort of significant step in bringing, it's an acceleration of effectively what the British hoped would take 50 years. There's a big step forward now, and Hong Kong being tied much closer. The leash has been shortened. So that means certainly knock-on effects for neighboring countries. It means potentially question over what will happen to Taiwan, but potentially Taiwan becoming more exciting. Definitely Vietnam, which Bob mentioned, has been a kind of secret weapon for us. Bankers and private equity firms were slow to see the opportunity in Vietnam. We moved there early, partly because a couple, as you know, Jordan, a couple of senior people who work for BDA had personal romantic entanglements or whatever, personal connections to Vietnam. Vietnam's been an absolutely spectacular market for us. And Vietnam now has a thriving stock market and a wildly successful private equity market, which is growing fast. And, the Vietnamese have been smart to try and take advantage of being kind of a foil to China. So, again, I can't simply describe what will happen in the future of the world other than to say things do evolve. And Bob's right. Don't put all your eggs in one basket. I've always said that, we're very pleased at BDA that we have offices all over Asia. And often we see that when Korea is going through a tough patch, maybe Japan does better. We're seeing one thing we haven't talked about on this call. Japanese buyers globally are being quite aggressive today. Historically, they had a bad reputation for taking a long time to get anywhere on deals, for being slow and indecisive. We're seeing very aggressive activity by Japanese buyers who are absolutely conscious of the fact that to some extent, the mainland Chinese buyers are locked out of auction processes globally. And so, Japan is trying to fill the gap and trying to find opportunities that have been created by China friction. So yeah, things evolve, and again, nothing is permanent. Nothing stays in one form forever. And Hong Kong is clearly having a really bad patch today. But as always, we hope and expect eventually cooler heads will prevail. And Hong Kong's a wonderful city that I love, and where I've been very successful in my career and had wonderful experiences. I don't for a moment think it's over forever.
Joanne, I'd love to hear your perspective. Ewan talked about Vietnam being the secret weapon of their advisory business and seeing things that others in Africa. You invest across Africa. What are some of the things that people need to know about particularly interesting places to deploy capital?
So overall, we're focused on some of the larger economies because we are investing in established, profitable businesses. So that would include the major economies in Africa. And a lot of times we do execute Pan-Africa or even back regional champions. There are extremely low levels of debt available in Africa. So our entire investment thesis is really dependent on growth rather than financial engineering, or I know the conversation in Asia was also around trade, or there's also export considerations. This is not so much a worry for us because we're focused on the middle class consumer. So what we're finding currently, we think that this recent crisis is quite unprecedented, but Africa is used to shocks, recessions, civil unrest, natural disasters, and even the most recent pandemic. Having lived through Ebola myself a few years ago, we've seen this, and so we're used to this. But DPI's thesis is really focused on the middle class consumer. And we see that the consumer is hurting. Discretionary income has gone down and perhaps completely shifted to non-discretionary in some cases, but the consumer still needs basic goods and services, still needs financial services, healthcare, education, still needs to eat. So I think where we've really focused our portfolio and the investment opportunity is around the affordable value segment, and also businesses that can innovate in terms of how to reach this segment of the consumer. So that has to do with different delivery models, kiosks where consumers don't have to actually go into a storefront and can pick up the whatever they've ordered outside at the sidewalk. But overall, leapfrogging in Africa is a core thesis. So for example, very little landlines. So everybody's dependent on their mobile phone, which is everything. It's a mobile wallet, it's a form of communication, it's a way of life. So the digital and e-commerce story is very crucial. I think the other thing just to touch on is, that's very important for private equity is exits. We're getting asked a lot about impact of COVID on near-term exits. Would say that from a there is still demand for very high quality assets, and we had kicked off an auction process for one of our companies just before COVID hit in February. We're still in discussions with buyers and negotiating on a normalized EBITDA basis. But what's actually been quite a bit of a surprise to us is that some of the bidders have indicated that they do not need to do on-the-ground visits and that they're comfortable closing with desktop DD, or in some cases outsourcing maybe to a third-party local consultant. So again, we think that in some instances it's business as usual, but would say with some processes that are much earlier on, there is a bit of a delay.
Thank you. So we have about 5 minutes left, and I'd like to kind of get to these questions that the attendees have asked. And if we cannot do them, we'll do a follow-up in an email with some Q&A. First by James Hoffman, I have a general question about how these structures get unwrapped in return to Hong Kong and China take private deals. Points of resistance.
Duncan, I think you better take that. Sounds too technical for me.
Well, so the experience that I have last year, I worked on a deal where a Chinese company was investing in the U.S., and I think might be the reverse of the question, but a Chinese company was investing in the U.S. and opted not to go through the CFIUS process and experienced a post-closing CFIUS review and was forced to unwind. I know a lot of people are familiar with the grinder process. There was a healthcare company in Cambridge that was involved in one of these. There was a large asset manager that had to do the same in a cybersecurity company. And those are always messy. You do not get fair value for unwinding those kinds of transactions. And I think that it's a great opportunity for buyers in China to take those assets back. But for the buyers in, for the U.S. companies, in my experience, it hasn't ended well.
Thank you. All right, let's go on to the next question. Have you found it more difficulty in funding particular deals that are diversified, or more difficulty with deals that are primarily segment focused in the last few months? So I think it's kind of question around broader, more focused companies or more broader companies. And
focused companies trade better, easier, at higher multiples. It's hard to find buyers. As someone who helps people sell companies, it's hard to find buyers to execute again at full price if there's real diversification. And we are gradually moving towards a more specialized world, gradually but inexorably. And we at BDA tried to pioneer sector specialization in our banking practice in Asia 20 years ago. Now we're seeing all over the world, private equity funds are increasingly specialized. And I think people are looking to invest where they have real domain expertise and domain knowledge. So yeah, I'm afraid specialization is becoming, gone are the days of being able to be a gentleman scholar, a relaxed all-rounder. Those days are long gone, I'm afraid. You better learn something and focus on that.
And it's even harder for the investment banks to sell a diversified company because the lack of focus. Are you going to price it off of revenue, or are you going to price it off of EBITDA? Of course, we would love to price it off of revenue, which means you need a very compelling SaaS-based story if it's a software company. And if you can articulate, if it's based off EBITDA, the growth potential. But when you have two or three different diversified companies, growth might be high here, it might be there. You're going to get a dummied down valuation. So we did about 9 years on the industry as well.
I've spent the last 18 months trying to sell a company which is exposed half to the aerospace industry and half to the semiconductor industry, and half the, 50% of buyers have said, well, we'll pay you 8x for this, but we'll only ascribe 4x to that. And the other half have said the reverse. So yeah, it's hard to do those deals.
All right, and for our last question, before we go to a flash poll at the end to see if you like this or not, the last question is, would love to hear the panelists' thoughts on the way the upcoming presidential election will affect their businesses and strategies. Rather than going into detail, let's just do a flash question around the table, which is, to what extent are you considering this in how you are making your decisions? On a scale of 1 to 5, 1, not really, 5 being absolutely it's in the front of our mind. Let's go around the table. Joanne?
2.
2? All right. Bob?
Yeah, 2 to 3.
Andre?
2.5.
And on the advice side, Duncan and Ewan?
Yeah, 1 or 2.
Ewan?
1 or 2.
All right. So the summary is
meh. But we can't base our business on this.
All right. So I'm going to launch a quick poll for everyone. Please drop your thoughts in here. Was this worth your time or not? Yes, pretty good, meh, or nope, it was not. Please drop your thoughts in here. Would love to hear your feedback. If you have more questions afterwards, please feel free to email me. Any parting words from the panelists reflecting on the past hour, starting with Ewan?
This too shall pass. The future is better than the immediate recent past.
Duncan?
Yeah, it's just looking forward. I closed a deal in Switzerland 2 weeks ago, and the sellers in Zurich were actually able to go and celebrate with a beer. So looking forward to do the same shortly here in the U.S.
Joanne?
Yesterday, I had my 3 remaining in-person meetings for December canceled, so I'm not hopeful that there will be any in-person meetings for the rest of the year.
Andre?
I think the mindset is staying flexible, and I'll take you up for the beer anytime soon. Then can we invest in a beer business?
You did. I think I remember last year going to an Upper East Side to celebrate that. Bob, parting thoughts?
Since the Articles of Confederation, we've had 47 recessions, and each one we've come back, and in the last 2 or 3, the markets have rebounded 56 to 85%. Length of rebound, it was not a determining factor, so if it's 6 months or 2 years, and the median gain in all cases was 60.8% since 1945. History repeats itself.
Bringing us home strong, Bob. All right, panelists, sponsors, and attendees, thank you so much for joining, and we'll be following up with the video, the podcast, and written materials. Thanks so much, and have a great day.
Thank you all.
Thank
See
you.
ya.